What is up, guys, and welcome to lecture 6 of the TCT mentorship, where we will be talking about advanced TCT schematics. Okay, now in the beginning lectures, we have laid the foundation of our trading. We've talked about market structure, ranges, supply and demand, liquidity, and then in lecture 5 we went into TCT schematics. But because you know the foundation, you kind of understand why they work, okay? And the theory behind them. And in lecture 5, I taught you everything that you need to know on how to identify them, what to look for, how to trade them, how to confirm them, the targets, the invalidations, and all that good stuff, okay? In this lecture, we will be going over the advanced details that will just turn you into a pro, a master, okay? It's those little tweaks to improve your risk to reward, to potentially extend your targets beyond the opposite range extreme point, and all that good stuff. However, it is important that you understand and master the basics first, okay? So if you are still having some trouble identifying the proper TCT schematics, first, I would love to see you and your questions in the Discord server, okay? It's a community of like-minded traders where I myself will also be located to answer any questions that you may have about the course or live price action. And furthermore, you'll get exclusive trading setups. You'll basically just be trading with me and all of the TCT traders, okay? So I hope I will see you in there. But if not, that is totally fine. Just make sure that you put your ego aside and realize, hey, am I ready to go into the advanced section? Because if you're not and you'll still go into this advanced section, you will be putting your focus in the wrong place, because you need to master the foundation first before you go into any advanced details, because the advanced details will not matter if you don't understand the basics. Okay, so let's just hop straight into it, because I think this will be a longer lecture. Taking a sip of my water. Okay, so the first advanced concept I want to talk about are distributions that can turn into accumulations and vice versa. So when we are trading TCT schematics, we always target the opposite range extreme point. And based on the bigger picture, the context, we can determine, if it will have follow through or not. And I've been telling you guys this for a reason. Why? Well, the same way, if price starts deviating the low, confirming a potential TCT accumulation schematic, the same way price could be confirming a TCT distribution once that range high target of the accumulation gets hit but starts to deviate. So let me visualize it for you guys. So let's say we are trending up, okay? Let's say we are trending up and we have a model 2 distribution right here. We pull our range. There we go. Range high, range low, deviation. This meets all the requirements for a valid third tap. And then we go down, okay? Now, what happens, or what can happen, is that price starts coming down, but instead of breaking the low, we will start deviating the low. Well, if that happens, we could have a potential accumulation schematic in the making, where this model 2 distribution with its 1, its 2, and its 3 can turn into a model 2 accumulation. And that's always a possibility. And that's why I'm normally always referring to the target being the opposite range extreme point. because a distribution can always go over into an accumulation, just like the accumulation can go over into a distribution, okay? And this is why building context and understanding where we are at on the chart is crucial for correct expectations regarding if your accumulation, for example, will have follow through or turn into a distribution. Okay, so let's look at it from a live trading example. So right here we have BTC and it's the 25th of July. It's the 25th of July, and let's build some context. Okay, let's build some context. So as we can see right here, we had our range low. Our range low got deviated and we broke structure back inside the range. Lower highs and lower lows. Right here we broke it back to bullish. Expectational order flow changes to higher low and higher high. And right here we entered into this 8-hour order block for a potential higher low for a higher high. Now, how do we confirm a higher low for a higher high? By looking at that structure from top to bottom, and when that breaks back to bullish, that is when we can have that confirmation using the domino effect to have a rotation back up towards that high. Okay, so that is the context. That is the thing you need to be aware of when zooming in on the lower time frame. Because right here we can see on the lower time frame we entered at POI and we broke our structure back to bullish right here. Okay, market structure break back to bullish. After a market structure break back to bullish, but followed a higher low for a higher high. In an uptrend, we pull our range from top to bottom, and there we go. Okay, there we go. So, zooming in on what we got going on right here is we have our range high, we have our range low, and we have deviation 1 not closing above our DL2, so it's a valid second tab, so we're going to extend it towards that high right there. And then we have a potential tab 3 that swept all liquidity. Okay, this did not go higher on other exchanges. I'm on the USDT Bybit right now. It didn't go higher here as well. It looks like equal highs, but it did not. So it meets the requirements of sweeping all that extreme liquidity. Now we just need to wait for a structure confirmation. Okay, structure confirmation, we wait for that break of structure low right here. It was 2 consecutive candles on any other exchange, and then whenever that break of structure appears right there, that is when we can go short. Okay, that is when we can go short. Now, it is important, okay, to recognize now, is this distribution going to have any follow through? Or will an accumulation make more sense? I just gave you the bigger context about this breaking back to bullish, being in a bigger uptrend, and potentially, having that rotation all the way back up towards that high right here. Okay, using the domino effect. So I would not be aiming for this distribution to have any follow through. Matter of fact, I'm expecting it to turn into an accumulation. Okay, so what developed from here is that price started deviating the low, coming back up, and from here we turned it into an accumulation schematic. So as we can see right here, we had that deviation staying inside of our DL2, mitigating some demand on the left. We can see the top of this structure demand with that inefficiency getting mitigated, and then price coming back for some sort of extreme demand right here. This last little order block, okay, breaking structure back to bullish right there, confirming that this is the third tap and price can have a rotation back up higher. Let's make it beautiful. There we go. Now, guys, for the accumulation right now, yes, this accumulation can actually have some follow through, referring to the bigger context we just discussed. Because technically speaking, if we start breaking that high, we can turn or we can take this trade all the way back up towards that high for a 14 risk to reward setup. Okay, and that is also exactly what happened if I play it through. Eventually that got hit right there. It took a while, but it did get hit. But the beauty of it is the fact that you can see right here that a distribution, okay, a distribution can turn into an accumulation, okay? And you'll see this all the time, all over the place, especially when trading lower time frame schematics. It happens all the time. And that is why understanding structure to lay that foundation, to build that context, is so important. Now, another example is right here on Euro, okay? So if we want to build some context on Euro, we were basically downtrending, okay? We were downtrending in a macro trend down, lower highs and lower lows, where this was our most local downtrend of lower high and lower low right here. Let's make that red. So breaking that red high will be your first signs of strength. Not breaking that red high is very weak because it's the most local downward trend. Okay, it's the most local downward trend. So if you cannot even break your most local market structure high back to bullish, that is bearish. Okay, and we started wicking it, creating a range. Well, what happened? We are trending up. Okay, higher lows and higher highs, range high, range low, deviation at the bottom right here. We zoom in on the 2 minute. Okay, we zoom in on the 2 minute. Got the deviation high as well. Okay, deviation at the lows, deviation at the highs. Got that 2 minute demand zone right here, 2 minute order block for our extreme demand. Came into it, went on the lower time frame like the 1 minute, confirmed the entry, and then that is your long. Now, I was expecting a rejection from this liquidity point based on some unfinished candle business discussed in one of my YouTube videos as well. So I was expecting lower here, but as you can see, price had that Model 2 accumulation that got confirmed right here. You could have longed it back up. Could have longed it back up towards that range high. Okay. And then from there, you can see it turned into that Model 1 distribution. Where right here, we got the break of structure confirmation. And then right there, you could have shorted back down. And that actually had some follow through because we were already expecting price to go lower. Boom. You see how that worked? This Model 2 accumulation brought us to the high that turned us into a Model 1 distribution schematic. Literally, guys, you see this everywhere. Now, there is a difference between this accumulation flowing over into this distribution and this distribution flowing over into the accumulation. Why? Well, it happens quite often that prior to confirming either the accumulation or the distribution, you have deviations on both sides. So prior to confirming the accumulation, you already had a deviation of the highs as well. You didn't have that here. Right here, when you confirmed that distribution, you didn't have the deviation at the lows yet. Okay? And in the situations where you do have deviations on both ends, you can't just target the opposite range extreme point once your confirmations have been met, because there's always the possibility of price turning into an opposite Model 2 schematic. Okay, and we have different examples right here. So what I mean, if I have to draw it for you guys first, is let's say we have that accumulation schematic. Okay, we deviate the high, we deviate the low. Okay, and we get that confirmation right here. Now, let's say this is our range. And we have our range high, we have our range low. Right here. Boom, boom, deviation 1, deviation 2. And right here we confirm like an extreme liquidity sweep, making a valid third tap. There you go. Let's say there is supply. Let's say there is supply right at that high, in that pivot point of that deviation at the highs. We are trading the Model 2 accumulation right here, but we cannot just target our new deviation high because it has always the possibility to turn into a distribution, a 1, a 2, a 3. So it's very important you watch that structure from the low up, because if that breaks back to bearish, that will confirm the distribution, right? But you always have to be aware of that and do not get trapped into thinking, oh, we have to come towards that second tap high. No, it can turn into a distribution. So be aware of that. That's exactly what happened right here. We had some supply, but structure never broke back to bearish, okay? This right here was a wick, so it never broke back to bearish, also not on the higher time frame. So there was no reason to panic. You had this 2-minute supply zone right here. But structure never broke back to bearish, right? You had highs, higher lows. So there was no reason to panic. But if it did break structure coming into that 2-minute order block right here, that is a sign to go short and to take profit on that accumulation schematic trade, okay? Based on the drawing right here, you can see on the right. They're basically the same. However, structure didn't break, so then you can just trade the Model 1 if you get the confirmations. Another great example of this is on the S&P most recently, because guys, these TCT schematics you can trade on any asset, okay? Stocks, forex, commodities, futures, you name it. It works everywhere, absolutely everywhere. Now, what we can see right here is that on the 6-hour time frame, okay, on the 6-hour time frame, we can see we have a higher low and a higher high, drawing our structure, pull our range from top to bottom. There we go. We have our range high, we have our range low, we have deviation at the high, and we have a deviation at the low, indicating a sign of an accumulation and a sign of a distribution, okay? We don't know in that moment which one it will be. We can have an expectation, and we can already check what that expectation could be. Why? Okay, let's check. By building bigger context, I'm zooming out. We are trending up. In an uptrend, I pull my range from top to bottom, okay? So we have a range right here. Price came into premium pricing of that range. Right in the pivot point of our market structure pool, we have supply. This is extreme supply because it's the last supply remaining before taking your range high. You're in extreme premium pricing. So what do you think makes more sense, an accumulation or a distribution? Obviously, it will be a distribution because prices in ranges, they rotate. You just had a rotation towards the range high. Now we can come back down again until price decides to either break up or down. But we want to be looking for bigger shorts in the premium section of the range and bigger longs in the discount section. We don't want to try and catch a crazy long in the extreme premium pricing of the range. So again, that's when building context plays a big part. So what we can see right here, that we have a deviation at the low and the highs, and we had supply right here. We had supply right there for a potential valid third tap. Let's check our structure. We can see we had a market structure confirmation right on this break, called a break of structure. Right there on the break of structure, you got that confirmation. Can I target, okay, can I target the range low? Not per se, because this can turn into an accumulation schematic because you also already have the deviation at the bottom right here. So let's check where is that extreme demand and where is that extreme liquidity. Right here we see that 6-hour order block in that pivot point of that deviation. Let's put that there. Then let's grab our extreme liquidity. That will be this low. It's the most obvious low. It's the structure from top to bottom. Keep that demand. Make this extreme liquidity. There you go. So the moment you take that extreme liquidity here, this could be a 1. This could be a 2. And this can be a 3. We just have to wait for a structure confirmation, just like with anything else, right? Now, right here, you got that structure confirmation. You got the SFP first, and then right after that, you got that breakout structure right there. So that's the confirmation that this Model 2 is confirmed and price will come towards that range high, making this Model 2 distribution fail. Okay, so the moment you break structure right here, that's your risk on trigger for longs and your risk off trigger for the short. So when you go short, we can't just target that range low. Now, keeping that bigger context and the bigger picture in mind, we are still expecting a distribution. But if the distribution Model 2 failed to confirm or failed to hit its target, and that failing is confirmed on that bullish break right here, we can expect it to go over into potential Model 1, which is exactly what happened right there, where this Model 2 accumulation went over into this Model 1 distribution. That got confirmed right there. And since then, we had that massive move down. Okay, so you can see that on this Model 2, we can't just target the range low because we also already deviated the low. And then we just have to wait for a structure confirmation that will determine if we're either going to go to that low or fulfill this Model 2. And then the moment this Model 2 hit its target and we got the distribution short, that's when we can target the range low, because now there's no reason for it to be a Model 2 because you already had one. Okay? It could turn into a Model 1 accumulation. That's always possible. But we were not expecting it based on the bigger picture. Another great example is Ethereum right here. And I've already have it laid out for you. So we were trending up from the low. We were trending up right here. Our string structure being higher lows and higher highs. And right here we created our range. Okay, range high, range low. And from there, we had that deviation 1, deviation 2, got our entry trigger right up here. Okay, it was even higher up on the lower time frame. But prior to this Model 1 distribution confirming, we already had a sweep of our range low. Now, right here, we have our extreme demand and extreme liquidity. So we have to be aware that the moment price mitigates that extreme demand and grabs that extreme liquidity, it could turn into a Model 2. So the moment you have a breakout structure in here, that's your risk on trigger for the long and your risk off trigger for the short. And price had a reason to potentially come higher because we still had that unmitigated supply zone above where price could potentially come back into. Okay, but as you can see, we have a picture perfect Model 1, but it doesn't have to hit its target if we already deviate the low, because a distribution, like just discussed, can turn into a accumulation. And when we already deviated the range on both sides prior to confirming one, can also flow over into the other. So be aware of that. Okay, be aware of that. Now, take a sip of my water. The second advanced concept we will be talking about are low time frame ranges turning into high time frame ranges, and therefore also low time frame TCT schematics turning into high time frame TCT schematics. And it is very important to understand how a low time frame range behaves so it can grow into a higher time frame range. Because every start of a high time frame range was created on the lower time frame. Just like your higher market structure pools are created by those pivot market structure breaks on the lower time frame. So the higher time frame is important, but the lower time frame makes up the higher time frame. And the same goes for ranges, okay? And understanding how to properly identify the correct points for the high time frame range, it will allow you to zoom out, reanalyze what price is doing, and not get stuck into trading ugly ranges with many weird deviations or being on the wrong side of the market, okay? So I can already tell you how a low time frame range goes over into a high time frame range, okay? So just got a notification on my PC, just making sure everything is still good, but we're all good to go. Okay, so what you'll see after an aggressive expansion is market structure trending up. And we know after an aggressive expansion, price loves to create a range. And that range will always start with a low time frame break. On the low time frame, you will have some sort of break of structure, okay? On the low time frame, you'll have some sort of break of structure. And then it will follow with like maybe one lower high for a lower low, and then it will come back up again. Why will it come back up? Because your higher time frame structure will look something like this, all applying the 6 candle rule, obviously. Okay, so you have those low time frame breaks, but those low time frames just make up one higher time frame market structure pool. And then following that higher time frame, our red market structure drawing in this example, this will be your range. Okay, and that will kind of be, the first range that gets created. And then that range will, maybe have like a model 1. Maybe it has like a little Wyckoff schematic, little model 1 with our 1 tab, our 2 tab, and our 3 tab. You'll come back inside, okay? You'll have a rotation down. It looks like you're breaking the range low, but then you'll come up very aggressively like this, okay? And why is that? Well, that is because black is representing our low time frame. And from our low time frame, a mid time frame range started like this with our red market structure drawing. That broke down, but that breakdown is simply a higher low for a higher high on our high time frame. The same how our black market structure break created our red market structure range. Our red market structure range break created our blue market structure range, okay? Where this will be your range high. Right here, this will be your range high. And then this will be your range low. And now we have a macro range, okay, that can have many rotations before, potentially starting a TCT schematic. But this is exactly, okay, this is exactly how a low time frame range goes over into a high time frame range. It happens all the time. You'll have low time frame breaks. They will make up for a higher time frame market structure pool. That will have its own little range. That range will start deviating towards the upside and downside, probably both, and create in that way a bigger range. Where our black market structure is representing our low time frame, red right now our mid time frame, blue our high time frame. Okay? And then blue can come back inside and continue forming a range and do whatever it wants to do. Okay? And I'm not just making this up because right next to us we have the perfect example. This happens all the time, okay? And many people will get stuck into potentially, trying to keep on trading this red range, okay? And they will just count this as a deviation because maybe technically speaking it is valid, but they have to realize that rationality also goes a long way, and this just looks way cleaner, and that's why we always have to zoom out. Okay, it's very important to zoom out before zooming in again, and to not get stuck on the lower time frame. So let's look at it from a real life trading example. Okay, so I'm on the 15 minute right now. I'm on the 15 minute, and we can see that we are trending up, and we have a high, and we have a higher low, higher high, higher low, higher high. Let's make this that black market structure drawing. And hey, we can kind of see a range here. We're trending up. Pull a range from top to bottom. Use our DL2. Use our DL2. Kind of have a sketchy close above it. It's also on the 45. Very, very, very sketchy. Would still count it as a deviation. Extend it down towards the deviation low. And we can see we kind of had a local distribution here. A 1, a 2, and a 3. That hit its target, okay? And got that rotation back down. So we had a local distribution right here. A 1, 2, and a 3. That broke down from the range, obviously closing below our DL2. Like, this is an obvious break compared to that local close above we got right there. Now, what happened is, instead, if we follow this structure that obviously broke back the bearish right here, instead of having a lower high for a lower low, what we had was a move back up. Why did this happen? Well, one, we had supply up there, so there was a reason to. But if I zoom out, our black market structure drawing on the 15 disappears on the 2. And if I draw my 2-hour structure, we have a higher low and we have a higher high. Okay, let's make that red. See how that's literally representing what I just drew for you guys? So we had that local Wyckoff right here that broke back the bearish, but instead of having a lower high for a lower low, we created just another market structure pool, so we can ignore that black market structure drawing now, and then draw our range from top to bottom, range high, range low, and then here we are on a mid time frame range. And you can see how what we just traded completely disappeared. Okay? From there, we deviated our high, let's extend it, and we deviated once more right there, indicating yet again a Model 1 distribution, okay? Broke down, did not have a proper close above it because it came into this good looking structure demand right here, indicating a deviation, and we got a full rotation back up, okay? Full rotation back up towards our range high, just like this. Now, this is why it is so important to zoom out, okay? Because if you're not zooming out, you will just continue using this as your range starting point, count this as a deviation, extend your range like this, and you would have never caught the good trades we just discussed on the S&P, where this was a Model 1, because you'll have 1 tab, 2 tab, 3 tab, 4 tab, 5 tab, and you will not know what you are seeing on the chart, basically, because you're like, I have 5 tabs, but TCT schematics are 3. No. If I now zoom out on the 6-hour time frame, this structure pool disappears, and if I have to draw a structure using the 6 candle where we have a higher low and a higher high, and then we have a higher low, and then we have a higher high, completely ignoring this Model 1 distribution that we had on the mid time frame, and now this is representing our high time frame, okay? So that first beginning range, that was its own little thing. That was already its own little Wyckoff that hit its target, and now we are ready to start a new range using our 6-hour time frame. From there, we have a range high deviation 1, range low or range low deviation 1, and then we extend it, and now we got that model 1. So you could have only gotten and traded that model 1 as a model 1 if you understood to always check the higher time frames and understand how those low time frame ranges that started here turned into a mid time frame range here, turned into a high time frame range here. And it's always the same story where you have that low time frame break that then breaks still back to bullish right here because it was a higher time frame market structure pool, and the same for mid time frame to high time frame. So understanding, I need more water, but understanding how to redraw your new range points will obviously allow you to look at the right TCT schematic again, but that is not just it. Because on every TCT schematic we traded in lecture 5B, I taught you guys one thing to look out for. If you're not remembering it, shame on you right now. On every TCT schematic we traded in lecture 5B, I told you guys to look out for one thing, always. And that is to make sure what the highest time frame is that your range is valid on. And now let me explain. Okay, let me explain. So, I told you guys, check what the highest time frame is that your range is valid on. And why is that? Well, that is because, okay, that is because you could have different or basically the same TCT schematics within one range, depending on the low time frame and the high time frame in that range. So, let's look at an example on Ethereum right here. Price is obviously trending up, right? Price is obviously trending up, and we have a high, and we have a higher low, and we have a higher high, okay? In an uptrend, we pull our range from top to bottom. We have our DL2. We can clearly see this perfectly rejected from our DL2 line, not closing above it, indicating a deviation, okay? And then we have our range low. Now, if I zoom in, guys, on the 15-minute, the 5 to 15, you can clearly see it. You can clearly see it that, okay, we deviated our high, so let's extend it. I'm having trouble getting that perfectly. There you go. Let's extend it, and then let's zoom in. And we can see right here, we have this 2-minute supply, kind of creating a little supply chain right here. This was basically a structure supply, this entire move up, kind of pulling it up to that inefficiency right here because this is the only supply remaining. That's when I'll pull it up to still use that unmitigated one. And we'll have something like this. Now, if I'm on the 5-minute time frame, guys, this looks pretty clean, right? This looks pretty clean where we will have a one tap, 2 tap, 3 tap, okay? What happens? Price comes back down all the way towards the range low, hitting its target. Absolute lovely trade. But we already traded a 1, a 2, and a 3. Model 2 TCT distribution. Confirming it right here on that break. Okay. However, I need to check what is the highest time frame that my range is valid on. Why? Well, if I zoom out on the 1 hour, this is a valid range because you can draw using the 6 candle rule. 2 candles down, 2 candles up, right here. So this is a 1 hour range. But what happens on the 1 hour? my second tab and my third tab completely disappear, because this is not a valid TCT schematic on the 1 hour, because I can't draw this using the 6 candle rule, where each pivot point has those 2 candles. So this is not a valid model 2 on the 1 hour, but the range is valid on the 1 hour. So what I have to identify is, hey, right now my extreme supply is this 45-minute order block right here. If I zoom out on the 1 hour and price comes back in here, that will be, and that could be, my new third tap. So you can kind of trade a model 2 twice. Okay? You can trade it twice. Like this. You can trade it twice. One time on the 5 to 10 minute that already hit its target, and then we came back for a 1, a 1, a 2, and a 3. But the only way you would have traded this as a model 2 distribution is if you would have understand that you always need to check what the highest time frame that your range is valid on, and then understand the fact that you can trade a more local model 2 and then also a higher model 2, higher time frame model 2, okay? But only if you knew the information I just taught you guys, you could have catched that short. And that ended up being an absolutely banger of a trade. So always when your tab 2 and your tab 3 are way more narrow and close by than your tab 1 and your tab 2, right? So your tab 2 and your tab 3 are way closer than your tab 1 and your tab 2. That's when you have to be aware that, hey, if I zoom out, this will probably look like one deviation, okay? If I zoom out, this is just one move up and one move down, and this is our third tap, okay, where the 3 moves to here. And it can also happen when we're trading a model 1, okay? So let's say this is representing our 5-minute time frame. Okay? This is representing our 5-minute time frame where we have our range high, our range low, deviation 1. Let's extend it up. Deviation 2, okay? But then what happens is this. And then if you stay on this time frame, this will look like 4 taps. But maybe on the 30-minute, if this is representing your 5, on the 30, it will look like this. Okay, it will look like this. Where your tab 2 and your tab 3 on the 5 just look like one deviation on the 30. And this is often the time when you have like supply up here remaining that needs to be mitigated, okay, until we can actually start moving down, and you'll have this, you know, this mid time frame overruling that low time frame. But you can trade the low time frame schematic, okay? You can trade the low time frame schematic. Just be aware that it could come back up to create that higher time frame schematic. And you need to be aware of it most of the time when your tab 2 and your tab 3 are way closer than your tab 1 and your tab 2. Okay, my screen is a bit laggy, so my apologies for that. But that is basically the low time frame ranges turning into high time frame ranges, and then also low time frame schematics turning into high time frame schematics. So if you see a 4 tap, a 1, a 2, a 3, a 4, and it has that aggressive move towards the downside, recheck it again now, knowing this information. It will probably just be a 3 tab on a higher time frame. So let's delete all of this. Let's delete all of this, and let's talk about our next big detail. Okay? So, checking if everything is going okay. Yes, it's all going perfectly fine. That's good. Good, good, good. Back to action. Okay. In the third advanced concept, we will be talking about Wyckoff in Wyckoff and how this can drastically improve our risk to reward when trading TCT schematics, while also giving us extra confidence in our setups. So, what I mean when I'm talking about Wyckoff and Wyckoff is that our third tap, okay, our third tap of our initial TCT schematic has its own little TCT schematic. This way we can have an entry confirmation way earlier than the original break of structure level, causing our risk to reward to improve drastically. So, what do I mean? Well, let's say we have a model 1 distribution, okay? Just like this. Model 1 distribution, where we have our range high, range low, deviation 1, deviation 2. There you go. Now, what could be the case? What could be the case is that on the way, and on this move up towards that third tap high, we have lower time frame structure. Okay, that's completely normal. But that lower time frame structure could also have its little range. That could be a Wyckoff. Let's make it blue. Let's put the tops in there. Tab 1, tab 2, tab 3. So our own blue market structure pool could have its own little range where the bigger third tab will be one of the tabs of that own local little TCT schematic. And this way, let's say our main market structure low to break was, right here, which in this scenario will be obviously really good. Now we can already enter all the way around up here because that will be your local confirmation for the blue TCT Model 1 schematic, right? So we can enter here, target all the way down, instead of waiting to have to enter all the way down here to target that low, which will cause a massive increase in our risk to reward. But I want you guys to understand when I'm talking about Wyckoff and Wyckoff, I mean a Wyckoff in my a local TCT schematic in my third tap of the bigger TCT schematic, okay? So, putting it to practice, showing it in a real trading environment, we can see Euro USD on Forex. I like to switch it up, show some crypto examples, some gold examples, some S&P, some Forex. So, what we can see right here is we have our range low. Let's make this back to 20, or not 2012. Where I have our range low, we have our range high, we have our deviation 1, we have our deviation 2 coming into supply, indicating a Model 1 distribution. If I just had to wait for normal structure, let's do 5-minute structure, okay? If I had to confirm my entry using 5-minute structure, you will see we have high, low, higher high. Right here, this will be your market structure low. This will be your break of structure level to wait for. So you can enter on the break right here, put your stop loss above the high, target the low, okay? And you would have had an amazing trade with a risk to reward of 2.2. Okay, that was your risk to reward, 2.2. Now, as you can see right here, okay, if I put this to the right so the level and the horizontal level doesn't go through our local range, as we can see right here, we have an uptrend in our blue market structure drawing, okay? So when we're trending up, we pull our range from top to bottom, and we can see we have a local range high, local range low, deviation 1, let's extend it, And right here, we grab probably extreme liquidity on the lower time frame. Okay, let's go into 1 minute. Right here, we grabbed for sure extreme liquidity. We're trading a lower time frame. Schematic right here. So yeah, you can just kind of use this area as your extreme liquidity and extreme supply. It got mitigated right there. Let's pull it above because it's literally the only thing that there is. And then price comes for it, okay? Third tap, and right here, we broke market structure. So right there on that breakout structure, that already confirms, right on this candle right here, that already confirms this local Model 2 distribution schematic. But we know if we lose that range low of this local range, we can have a unconfirmed macro TCT Model 1 distribution schematic. So we can already enter here, just like we can enter on lower time frame structure and then wait for our higher time frame to break as well. Well, obviously the moment we were at that low, we broke, and now we have the same target, guys. We have the exact same target of the same setup, but where we had that 2.2 risk to reward now we have 9. Now we have 9, guys, which is an absolute banger of a trade. It's absolutely insane. Okay, just by trading the local distribution inside of the bigger distribution, we can improve our risk to reward and add an extra 7% net gain on the account, okay, which is absolutely amazing. Now, another great example was the public short I took on Ethereum, and this was absolutely a beauty of a short, okay? So what we can see right here on Ethereum is around a 12-hour range. We went up, we went down, higher low for the higher high. There we go. Pull our range from top to bottom, have our range high, have our range low right here. And then we got that deviation 1, deviation 1, deviation 2, indicating a Model 1 distribution, okay? Now, if we go on the lower time frame to see where that structure kind of is, I can see on the 2-hour here, pulling my structure from bottom to top. We have a high, higher low, higher high, higher low, higher high. So right here was our market structure low. We initially SFP'd it, and then we kind of kept SFPing it over and over again until right here. That's when we got a very convincing break, okay? Because then you kind of ladder it down because we get those expansions away from it. So if I had to, confirm this Model 1 distribution, it will not be until here, putting that stop loss all the way above there just to target the low. And you would have around a 1.46 risk to reward, which is decent, but not the best, okay? Now, if something may have already caught your attention, this was the range we just used to, talk about low time frame and high time frame TCT schematics. I don't know why my trading view is giving up on me right now, but okay, I think we're all good to go. Okay, so if something may have already caught your attention, it is that this right here obviously has its own little range, and is that range we just talked about, right? It's that range we just talked about where it had 2 Model 2 schematics, okay? 2 Model 2 schematics where right here we had our range. Range high, deviation 1, deviation 2, or third tap, I mean. Let's make those blue. And then we could have confirmed our entry right there. Let's zoom in on a lower time frame like the 1. There we go. Let's see where we can get that structure confirmation. There you go. Right here on the 2 minute. 2 to 1 minute, we get that structure confirmation. Price comes back for a lower high in our structure supply. Let's say we entered on that retest, put our stop loss above our third tap high. Now we can already enter up there for the target all the way down to here. Boom. That way, okay, that way our risk to reward changes from that 1.5 we were just talking about all the way to a 13 risk to reward. And you guys can see the move down was very smooth. So we had a 1, we had a 2, we had a 3, but our third tap had its own little 1, 2, 3. Wyckoff in Wyckoff, okay? Absolutely key, absolutely effective. Last example I want to get into is on the S&P range we were just talking about. So as you can see, we had that 1, we had that 2, we had that 3. We were already expecting a rejection right here because, you know, we were in this macro range on the S&P 500, and then we came into that extreme supply zone, which is nice resistance, okay? Came into that extreme supply zone, and we were kind of expecting a range rotation down. Ignore the ugly candles on the Wanda. They're having some problems with their data. But if we check how we came up there into that third tap high, we have a high, higher low, higher high, clearly indicating a range by already how extended and wide this V is. And then we have this. Okay. So we can see right here, we have our range high, we have our range low, and we have our deviation 1, okay? So zooming in, we can see that we have a 15-minute order block right here, which is our extreme supply, which got tapped right there. So the moment this got tapped and this liquidity got grabbed, we were meeting the requirements of a third tap, indicating a potential Model 2 distribution. And then we just have to zoom in on the lower time frame. Hopefully a Wanda actually had a confirmation. I don't trade on the Wanda, guys. I just put it up for the thing. Very ugly candles. Ignore it. But this is just a higher lows and higher highs. Okay, higher lows and higher highs. Right here we had that break of structure. And that is where you could have confirmed your entry on the break. Put your stop loss above the high. And then target all the way down towards the range low for a 21 risk to reward. That will be a 21 risk to reward versus a 2 risk to reward if you entered on the break of that range low or that market structure low, which you would have to wait for if you didn't know about TCT schematics inside of TCT schematics and Wyckoff and Wyckoff. Okay, you see that? A 2 risk to reward versus a 21. Absolutely, absolutely crazy. So the last advanced concept I want to discuss with you guys is Model 1s flowing over into Model 2s. So let's say price is trending down right here and we form our range, and then we have a Model 1 TCT accumulation schematic, okay, where we have our range low, range high, deviation 1. Let's extend our new range low to the deviation low. Let's make this black so it's more visible. And then we got that deviation 2. Okay, coming back inside. Right here, we broke structure back to bullish on the lower time frames, confirming the TCT Model 1 accumulation schematic. Now, what could happen is that price follows up with a higher low for a higher high, and then maybe comes back down, sweeping that liquidity before moving higher. Okay, well, right here, it must have then swept extreme liquidity and or it hit some form of extreme demand, confirming this as a valid third tab if we were to look at it from a Model 2 perspective. Okay, so you kind of have that one. You kind of have that one, that two, that three, but prior to price tapping your range high, hitting its target, it comes back down and it creates kind of a fourth tab, which is a higher low, confirming that this could also be a 1, 2, and 3 like this. Okay, so it's kind of a Model 1 that flows over into a Model 2. And this happens quite often. Okay, and what we can do and why this is so important to know and to understand is, one, we can improve our risk to reward, just like within within Wyckoff schematics. Right here, if I entered long, okay, on the breakup structure, and I put my stop loss below my third tab low, and I would target the high, I would have around a 1-to-1 risk to reward. It's not the best, but it's an example, okay? Well, what happens if price starts putting in that fourth tap, indicating this Model 1 flowing over into a Model 2, and we get a long confirmation right down here on that red market structure break, that means that this is our new Wyckoff point, okay? Because this is the third tab from a Model 2 perspective, meaning the invalidation will always be below your Wyckoff point. And since this has become our new Wyckoff point, okay, we can trill our stop loss down towards that new low. Now, right here, I'm risking 1% on a 0.17 stop loss. Now, I'm moving it down to 0.1. So if I was risking 100, now I'm only risking around 60. So what you can do is you can add that $40 risk that's gone because you trilled your stop loss. You can add it back on the trade right here. You can add that risk back, improving your risk to reward from only around a 1 to around a 2. Okay, because you will have an average entry that's right around there. Your stop loss will be below that low. And now you just doubled your risk to reward by trailing your stop loss to your new Wyckoff point if it meets the requirement of a third tab of the TCT schematics. And then you add that risk back on the breakup structure, confirming the Model 2. Okay, so this happens all the time. And sometimes you'll even see that tab 2 and tab 3, they disappear, okay, because they're too close. And it will just be a bigger 1, bigger 2, bigger 3, okay? So it's important that you know this. Otherwise, one, you can maybe start stressing when you see price coming back down below your entry. But if you see this extreme liquidity point and you see obvious looking demand, you already know in your mind that, hey, this could potentially turn into a bigger accumulation schematic. And if it does, guys, if it does, usually schematics where the Model 1 flows over into a Model 2, they have follow through towards the upside. Why? Well, it just shows that the market maker is not leaving any sell side liquidity behind and not leaving any demand behind, meaning he's fully positioning himself. We already had the Model 1 where he grabbed sell side liquidity twice on the 2 deviations, but he even made price come back for our extreme liquidity point within the range, meaning he's really positioning himself to push price higher. So normally when we have a good looking Model 1 flowing over into a Model 2, it tends to have follow through beyond its range extreme point. So a good example right here on Euro is that price was trending down coming into demand. Okay, so we had lower highs and lower lows coming into demand. Right here in a downtrend, we pull our range from bottom to top, and then we can see right here, we can see that first deviation staying inside of our DL2, So nothing to worry about from a break perspective. Price came back inside. Let's extend our range low towards our new deviation low. And right here, we got our deviation 2, indicating a potential model 1 accumulation schematic. Now we have to confirm the schematic. So let's go on a lower time frame. And we can see right here on the lower time frame, we have lower highs and lower lows. Okay, and right here, we have that break back inside the original range values. And we can go long right there. Okay, so right here, we can go long on this break of structure. We put our stop loss below our Wyckoff low, which is the invalidation. And then we target our range high for a lovely 3 risk to reward. That's amazing. Risk 1, make 3.16. Okay, now if I were to check, okay, where is my extreme demand and where is my extreme liquidity? Your extreme liquidity is right below that low. That's the most obvious market structure low prior to taking your third tap low. And obvious demand, there's not that much obvious demand, so I would use this pullback area that got mitigated ever so slightly here, but because it's the only demand area remaining, I'll pull it below that demand mitigation, like set in the demand tutorial or lecture, and then that will be my valid potential third tap. Okay, so as we can see, we confirmed the Model 1, price went up, but we were curving over, coming back down. Now, instead of stressing, we should realize, hey, it can either mitigate this extreme demand zone or grab extreme liquidity to go over into a Model 2 or accumulation, where this Model 1 is flowing over into the Model 2. Now, right here, we mitigate that extreme demand and we break structure back to bullish. Okay, confirming our accumulation schematic. Now, what does that mean for our trade that's already open? It means that right now, okay, our entry is right here. And our stop loss is right there. But the moment we get the break of structure right here, the new invalidation of the trade becomes below this low because that's your new Wyckoff point, your new Wyckoff low, okay? So what you can do is you can trill your stop loss, okay? You can trill your stop loss below that low, aka that low is above your entry, meaning your stop loss can go to entry and you are de-risked, not risking any more money on the trade. And what you can do is you can just add back the 1% risk right there and long it back up. So instead of only having this position open, which will net you around 3 RR, you can put your stop loss to entry on this position, open a new position with a 1% risk below that low because you want to risk 1% on the setup, and now instead of making 3, you're making 3 plus 2. So you're making 5. And I told you that if a Wyckoff schematic Model 1 flows over into a Model 2, especially on the mid time frame, you can expect some follow through. And look what happened. Look what happened. Price got the follow through. So maybe instead of just targeting the high, we would target this liquidity curve right up here, you know, fill some inefficiency right there and have this extreme or this good looking supply zone. So maybe you can even extend beyond the range high and just, you know, talk about, hey, maybe you want to grab all that liquidity curve or all the liquidity from the curve right here and fill this inefficiency tapping into that structure supply zone. And then you can even extend your targets all the way up there and you're netting over 6% and 5%, making 11% in one trade idea. Okay, guys? You really want to benefit when you have such a clean looking schematic and you really want to benefit when you are right. When you know it's a good setup, look how you can add more. Always look how to add more when winning. Okay? If I zoom out now on, let's say, the 3 hour, and we can check this range, you can see on the 3 hour that this is also a valid range, but your tap 2 and your tap 3 disappear, right? Your tap 2 and your tap 3 disappear right there, and this is just a 1. This is just a 2. This is just a 3, right? So on the 3 hours, a Model 2. And then on the lower time frame, it's a Model 1 flowing over into a Model 2. So that's something that happens quite often, and It's just good to know how you can, add more risk to the setup, because it just shows more market maker involvement and is really not leaving any demand or liquidity ungrabbed and unmitigated. Okay? Now, lastly, guys, before we will wrap it up, is I want to talk about that TCT schematics are absolutely everywhere. Okay? They are absolutely everywhere. And especially in high time frame pivot points. Okay, why? Well, a pivot point indicates a strong move away from a certain price point. And price is only going to have a strong move away if market makers stepped in and moved price strongly away. So in almost every major pivot point, it doesn't have to be in the exact low or in the exact high, but around it, you will find TCT schematics. So I've laid out the high time frame / mid time frame TCT schematics on BTC, and this is the one we discussed where the distribution went over into the accumulation. But right here we can see in and / around that pivot point, we had an amazing entry netting you over around 10% coming to that high. Right here in that pivot point, you had a distribution within a distribution netting you over 16% targeting that low. And then within that distribution, you had an accumulation and another distribution netting you over 5 and 6%. Right here, prior to dumping more down, you had a distribution. Right here, before pumping up, you had an accumulation. This was the most recent one that we absolutely nailed on X. Absolutely nailed this one, netting you over 11%. And right here in that bottom, you again had a Model 1 TCT accumulation schematic. And I'm just showing you guys, the higher to mid time frame pivot points. If I zoom in on the 3 minutes and the 5 minutes, we will find TCT schematics all over the place. I'm already seeing one right here, right there. I can already see that you have a range high, range low, deviation 1, lower high, nice liquidity trail, move down to follow, hitting its target, right? So they're absolutely everywhere. Absolutely everywhere. And in the next lecture, we will be talking, I think, about risk management and the power of only making 1% and how to use leverage to our advantage, what leverage actually is. And you will realize that you don't need that many trades to become very, very, very profitable. And with TCT schematics, the possibilities are literally endless, okay? They're endless because I taught you guys overlapping structure. So if price is trending up, okay, that means on the higher time frame, for example, if price is trending up, that means that we could have a potential range right here from top to bottom that could turn into a TCT schematic. However, to get from point A to point B, we need to have some sort of downward structure, right? And in that downward structure, every down pull could be a potential range. And that could be a potential range. And that could be a potential range. And then even dissecting that red market structure drawing in lower time frame structure, like our blue market structure drawing, to get, from that point to that point and that point to that point, we need more structure. So, using that overlapping structure effect shows you how many range possibilities there also are. And every range possibility is a TCT schematic possibility if requirements are met, right? So they're absolutely everywhere. And you just need to pick out the one, and we together are going to pick out the one that will be the highest probability to ensure your profitability in this trading game. Okay, guys? So that was it for the advanced TCT lecture. I'll see all of you guys in lecture 7. Peace out.